Good evening and a warm welcome to all the participants present here for this webinar series on tax audit practice sessions. And today is the 9th season of this entire series. This entire significant series covers various aspects so as the professional colleague can perform their duties much better. I, CA Amruta Kulkarni, Vice Chairperson of the Pune branch of ICI, take this opportunity to welcome you all and also recognize the presence of our Central Council member, CA Dr. Raj Chawla sir, who is the chairman of this Taxation Audit Quality Review Board. I also recognize the presence of our learned faculty, CA Rajendra Agiwal sir, who will be discussing the typical issues in tax audit today. So may I please request our chairperson of the TAQRB, Raj Chawla sir, to welcome the audience with his keynote speech.
Good evening, everyone. First of all, I welcome CA Rajendra Agiwal ji, our guest speaker for today's webinar. I also welcome CA Amruta Kulkarni ji, Vice Chairperson in the branch of WIRC. So, my dear fellow colleagues, I welcome you all in our 9th session of the series on webinar on tax audit. Today, we are going to discuss on the topic of typical issues in performing tax audit. As you know that TAQRB bring out this series of webinar in guiding the members for enhancing and improving the quality of tax audit. As you all are aware, tax audit have become increasingly complex and demanding, and it is imperative that we carefully address these issues to ensure compliance with income tax law and regulations. In recent time, we have encountered various challenges during the performance of tax audit that require immediate attention. In this session, we would try to highlight some of the typical issues that we have faced and we weigh the address to them. Now I request CA Amruta ji to please take it further.
Thank you, sir. To navigate the session further, it is indeed immense pleasure and privilege to welcome our learned faculty for the day, who will be discussing on the most critical topic, and that will definitely go in a long way while we all are performing our duties for the next maybe 2 months. And Rajendra Agiwal sir today will be discussing and sharing his valuable time.
Hello.
Sir, Sir was my partner in Rajendra Agiwal and Associates in 2008. His core area of practice is direct tax. He was also associated with Ernst & Young and was advisor for the direct tax vertical. Sir is now in his individual capacity looking after the corporate tax matters, domestic tax, international tax, and transfer pricing, mainly focusing on the litigation before appellate forum. He is also a life member of the Pune Chartered Accountants Society, Bombay Chartered Accountants Society, Chamber of Tax Consultants, Western Maharashtra Tax Association of Tax Practitioners. He was secretary of the Pune Income Tax Appellate Tribunal Bar Association for the year 17-18. Currently, he is on managing committee of the Pune IT-80 Bar Association. He was also the managing committee member of the Pune branch of ICI for the term 2007 to 2010. During the period, he was also the treasurer in the year 2007-8. He was awarded R.T. Doshi Foundation Award for article written on taxation of charitable trust in the year 2008, which was published by the PCAS. He has contributed several articles on the topic of professional interest published on IT-80 Online, Tax Sutra, ICI Journal, and the list goes on and on. Sir is a prolific speaker and an eminent faculty when it comes to topics on direct taxation. He has actively participated in all conferences, refresher courses, and also led as a group discussion leader. He has also been a visiting faculty in most prominent institutions in the Western Maharashtra, to name a few: Neswadia College, ILS Law College, BMCC, LK Phatak Institute. Sir was also the president of Lions India, Pune Ganesh Khen. With this brief introduction, I welcome CA Rajendra Agiwal sir for taking the session ahead and discuss more about the typical issues in tax audit. Over to you, sir. Thank you so much.
Thank you, Amrita ma'am. Good evening to all of you. Good evening to Chawla Saab, Dharmesh Sinha ji, and committee members of the ICI. I first of all thank you the committee chairman and vice chairman, and of course my Pune team that giving me the opportunity to share my knowledge and experience on the tax audit. And this is, in fact, sharing experience is nothing but a learning kind of thing, which enriches our knowledge, speakers' knowledge as well, along with the delegates. Because unless and until we are asked to look into the issues, we are not aware that there is some issue. So only when we take up for the preparation, then many new things also come to our mind, and that is certainly healthy practice for all of us. With this brief comments, let me turn to my subject regarding the tax audit. I was told by Chitale Saab that clause by clause analysis has already been done, and therefore I need not to go by clause. On the contrary, I was told to deal with the typical issues regarding some clauses of the common interest and all that, considering the litigation scenario. And as such, I am going to deal with the typical issues. I will not refer to any particular clause, which clause number of the 3CD, etc. But I am sure the issues which I have selected are certainly forming part of the reporting under the 3CD. And accordingly, I would like to present my views on the topic. I have also prepared a short note, which I'm trying to share on the screen. If it is visible, then just let me know. Amruta, can you see this? You are on mute. You are on mute. Is my screen visible? Yeah, thank you. So this is for the benefit all of us. The document is on the screen, and accordingly, I would like to proceed. If there is no connectivity or there is any volume issue, then just let me know. Otherwise, I will not come to know. Unless otherwise you show hand or something like that, I will not come to know that is there any disturbance.
Yes, I'm very much here, and I'll give you heads up wherever required. Yes.
Thank you very much. You know that we are in the month of August, and this period is spiritually very known to all of us, that we are celebrating the Adhik Mas or Shravan Mas as per the Marathi spiritual literature. And we believe that whenever our families, many families organize the puja with a faith that all our sins would vanish, and there will be a kind of punya in our what we can say in the tarazu, and that is the faith that we always believe that this is the annual feature, or whenever the Adhik Mas or Shravan Mas comes, and with this faith we proceed in the life. Whenever the month of after filing the returns for non-audit cases, month of July passes, and when we enter the month of August or September, and then the fever of tax audit get spread, and there are multiple seminars and webinars and study circle meetings are arranged annually on this tax audit issue. Though the tax audit is on the statute, I think by the Finance Act 1984, that is from AY 85-86, when actually I was appearing for the CA final examination. So I recollect when the first time the tax audit was introduced, there was a lot of pressure, a new kind of pressure on the entire fraternity. The people, I mean the students or the professional fraternity were used to stop that the certification or the particulars to be furnished in form number 3CD are so difficult and are so onerous that the if the members do not exercise the due diligence, then the members may be exposed to the disciplinary action. This kind of the this thing, the scenario at that time when the provision was first introduced by the Finance Act 1984 in the probably AY 85-86. Initially, when we started the practice, I think hardly there were 14 to 20 clauses in the form number 3CD. A very limited kind of information was asked. And I recollect the objective of the tax audit that to save the time of the AO and to make the ready-made information available as a tool in the hands of the department or the assessing officer to make the information available for the purpose of assessment of income. And probably the department can save their voluminous time which are spending on the other issues, and the quality assessments can be made. Actually, that was the intention to bring this provision on the statute. However, as the time passes, the forms are getting changed every 2 years. As I said earlier, that in the initial period, there were hardly 14 to 20 clauses. Today, we are facing the 44, 43 clauses, including information on the GST and etc. etc. Earlier, the information was restricted only to the one head of income, that is a profits and gains of business or profession. But now the forms ask us to give the details of the receipt under which are taxable by virtue of section 56, subsection 6, 7, 10, etc. And virtually income from other sources issue is also covered. Then chapter 6A deductions are also covered. So the scope of the tax audit is increasing day by day. Naturally, it is putting a lot of pressure on the resources in the office of the professional or chartered accountants, brothers and sisters, and we have to collect a lot of details from the books of accounts and present in the appropriate form with the dual objective, that is to minimize our risk as a professional when we are certifying the information, and at the same time the assessee's interest should also be protected. Not only that, the department collection and department interest is also supposed to be protected, because we have to act as a judicially, and neither we can take the side of the assessee nor the side of the department, and thus the independent judicial analysis of the information is very much required. And from that perspective, there is a lot of pressure on the fraternity as such, with the limitations that we do also have a limited staff or the skilled staff, and our clients may not also have the skilled staff or expertise to make the information available. And beyond that, certainly there is a time limit available to complete the assignments. And in view of this entire scenario, the issue of the tax audit discussion, the quality of the report has to be maintained. From that perspective, I think the webinar is very much needed, and let's try to take a deep dive in the topic as such. If there are any questions, kindly let me know in between. I will be happy to answer that, or we can reserve the last 10-15 minutes to take up the questions. I leave it to the organizers how to take it.
So, as per the discussions we had in the beginning, we can take the question and answer in the end, so that that can be collated by the admin, and I'll help you with the queries.
Fine, that's fine.
I'll share them. Yes.
Thank you very much. So, first of all, let me take the issue that what is the nature of the tax audit as such. The tax auditor is auditing the books of accounts. He is not computing the taxable income, or is not certifying the computation of the income. However, many clauses, especially inserted after 20th August 2018, notification number 33, dated 20th July 2018, require the tax auditor to act as AO and express the views. So, more very specific information is called, and therefore there is a feel that are we certifying the computation of income, or are we examining the books of accounts from the perspective of the 44 EB. The issue also carries importance and has come up before the Delhi High Court. In the case of Goodyear case, what was happened was, after the tax audit, when after getting the accounts audited, when the assessee submitted the return and its case was picked up for the scrutiny, the assessing officer has called for the certain details of the expenses, etc., to examine the allowance and disallowance. The record was voluminous, and therefore the assessee could collect the details of only 2 months out of the 12 months, and accordingly the details were furnished during the course of the assessment proceedings before the AO. The assessing officer said that you have not produced the entire record, entire details of the vouchers and details of the expenditure, and therefore I will allow the expenditure only to the extent of the details made available to me. Matter went to the High Court of Delhi, of course to the CIT Appeal and Tribunal, and it was assessee tried to argue that my books of accounts are audited and therefore no disallowance should be made because some authenticity has to be given to the books of accounts. In that context, the court had held that it was not desirable to enter into the area of factual adjudication, which was foreign to the scope of an appeal under jurisdiction, because it is not a question of law. The other question which was highlighted was that when there was a tax audit under section 44AB, the ITO should not insist upon the production of the records or vouchers or the details. The High Court said such a broad proposition could not be laid down. No doubt, the sanctity has to be attached to the audit report given by the qualified chartered accountants, but merely because an audit report is available, that does not mean there is a fetter on the power of the ITO, or ITO's power are restricted to require the assessee to justify its claim with reference to the records, material, evidence, documents available on the record in the custody of the assessee. Such a power is inherent in an assessing officer's hand as per the scheme of the Act, and therefore the assessee's contention had been rejected, saying that there are no fetters on the powers of the AO. So that indicates that there is a sanctity for the audit report or the details certified in the form of 3CD. However, it cannot be taken the shelter to such an extent that the assessing officer should be stopped from asking any details just because the books of accounts are audited. So this is the nature of the tax audit. Now, when I said that whether the tax audit, are we certifying the computation of income or etc., if we compare the other provisions of the Act where there is an audit is prescribed, then probably one can understand the difference in a larger sense. And what is that? You are aware that the special audit is also prescribed under section 142 subsection 2 capital A. If we compare the provisions or the procedure prescribed under section 142 2A vis-a-vis simultaneously comparing the provisions of section 44AB and the information to be certified by virtue of form number 3CD under section 45AB, the difference is quite obvious. What is the difference? The difference is that under section 142 2A, the audit expenses are to be borne by the assessee, and in 44AB audit, the audit fee etc. is the contract between the auditor and auditee. This is one aspect. The second aspect is the audit under section 142 2A is not recommended based on the turnover or etc., but it is recommended on the basis of the complexity of the books of accounts, whether the assessee, where the AO is able to understand the books of accounts and deduce therefrom the computation of income, and it is a more a kind of investigational audit under section 142 2A, while under section 44AB, certainly it is not a kind of investigational. We are not there to expose in to the assessee or not to benefit the department, But our role is very limited to the stating the facts of the case, the specific questions or the provision of the law, and what are the facts are required to be stated in the given circumstances of the case. So that is the nature of the tax audit, and as compared to the 142(2)(a) audit. This is the main difference. Now, why am I bringing this to the gathering that here that the disclosure or the comments or the observations we report in form number 3 CD, it should be articulated in that fashion. What is when I say that it should be articulated? Articulated means articulation does not mean to furnish the inaccurate data or conceal the facts, but articulation also does not mean twisting of the facts. But articulation by I mean that whatever the facts are to be stated, that are stated correctly, deduced from the books of accounts or records, and those are falling within the framework of the law. So as an auditor, as an independent person, I have to state the facts and figures and express the compliance of the law in the view of the question or the particulars asked to me to furnish by way of form number 3CD. This is the nature of the tax audit. Now, tax audit limits. Earlier, it was only a fixed limit of 40 lakh, and for professional 10 lakhs for all kinds of business, assessee carrying on the business or profession. But now, as the time is passing, different kind of limits have been set for the purpose of 44A audit. Somewhere it is 1 crore, somewhere it is 2 crore by virtue of some section. For professional it is 50 lakhs. So different kind of limits have been set in the statute for the purpose of tax audit, getting the tax audit to be done. One of the recent amendment is that if the cash transactions are less than 5%, then the turnover is the limit is increased from 1 crore to 10 crores. So normally, when we examine this, normally we should take a declaration from the client that the cash transactions are within the limit, and therefore the limit applicable is 1 crore to 10 crores. And apart from that, from preliminary point of view, we can also have a look at the cash book and compare whether the using the software, etc., whether the this threshold limit of 5% is crossed or not. Also, now there is a provision of filing the form for specified transaction, financial transaction, that is SFT. And now in the SFT, one of the purpose is to report a transaction wherever there is a cash is received from the customer above rupees 2 lakh. So the auditor can also call for the SFT report, can look at the SFT report, and whether there are any transactions where the large volume of the cash has been reported by the assessee. That will be also a guiding factor for the purpose of finding out whether the limit of 5% is broken or not, and accordingly the turnover limit can be fixed up, and accordingly the limit, whether the 1 crore or 10 crore is applicable, that can be fixed for the purpose of carrying the audit. Further, in this context, it has been clarified by the amendment by Finance Act 21 that whenever there are cross checks or DD, those are to be excluded from the domain of the cash. It means if the payments or the receipts are done by bearer check other than cross check or bank draft, then that will be deemed to be a cash transaction for the purpose of this compliance of this provision, and accordingly you have to take a call whether the 95% threshold is broken or not, and accordingly the turnover limit is to be applied for the purpose of getting the accounts audited under section 44A. This is with reference to the nature of tax audit and the turnover limit and all that. Now the next question is business or profession. We are aware with the particular activity is to be called as a business or it is to be called as the profession. Whether section 44 AD is applicable or section 44 ADA is applicable, because section 44 AD talks about the business, while 44 ADA talks about the profession. Now, some times the nature of activities which are carried out by the SSE are so confusing that sometimes we get confused whether the activity is to be called as a business or it is to be called as a profession. And suppose we call it as a business, but department takes the view that it is a profession, then in that scenario, the turnover limit will be changed, and accordingly, unnecessarily the client will be exposed for the purpose of the penalty for not getting the accounts audited or for not complying with the provisions of the law. Of course, suppose I take the view that particular activity is a business, so larger turnover limit is applicable. And if the AO takes the view that the particular activity is a profession and therefore the lesser limit is applicable, and suppose the tribunal or the court upholds the view of the AO, then probably I will be exposed to the penalty for not getting the accounts audited. However, in my view, if really the case is on a boundary line or there is a confusion in the area, then one can argue on the basis of the reasonable cause that I formed a belief that particular activity is a particular activity is a business, and I thought of a larger limit of the turnover, while ultimately it has been held as a profession. However, for forming such a view, there is a reasonable cause, and if you can prove the reasonable cause, then the penalty under section 271B is liable to be deleted or cannot be invoked. This is the case of the business or profession. In this context, the one can refer to the decision of the Jodhpur Tribunal in the case of Sunil Chandak. Taking the clue from this decision, the following are the activities where there can be a confusion. For example, activity of nursing home. When number of doctors are coming together, and suppose one doctor is a main doctor, is taking the entrepreneurship role or is a passive in his activity, but other doctors are playing the active role. So that is the activity of the nursing home. The question arises whether the nursing home activity run by the doctors is a business or profession. Secondly, I have faced the real-time case, whether the activity of the beauty parlor, whether it's a business or profession. Then suppose activity of the big law firms, the well-known firms are hiring the lot of lawyers and they are running a big law firm, whether it's a business or a profession. All number of lawyers are coming together under one roof and they are running the law firm. So this kind of activities can be, we can think of multiple combinations, permutation combination, and then the question arises whether a particular activity can be termed as a business or it can be a profession. The one more aspect, whether the risk factor will decide whether the character is of business or profession. Normally, we are aware that in case of the business, the businessman runs higher risk than the professional. Professional normally do not take the risk. And even if the profession is taking the risk, that is very, very unknown because of his exposure of knowledge or something. But in a business, there is a kind of financial risk. I mean, businessman will borrow, will invest, and then he will do a cost benefit analysis. So risk parameters certainly vary in the case of the business or profession. And accordingly, this can be a guiding factor whether to consider a particular case as business or profession. Then whether the capital employed would have a bearing on this. Certainly, normally in the case of professional, the capital outlay is very minimal. While in case of the business, we can expect the capital outlay at a much larger scale. and that is the difference, one of the factor which will also guide us to take the call whether to call the particular activity as a business or profession. If the role of the entrepreneur is passive, then there is a scope to argue that the activity is not a business. There are certain professions which are already specified under section 44AA of the Act, which are called the specified profession. These are in the field of accountancy, legal, medical, company secretary, engineers, architects, film artists, technical person engineer, interior designer, and technical consultants. So these are the specified professions for the purpose of the Act. Then the turnover, the next criteria is for deciding, particularly in a peculiar area, how the turnover or gross receipt should be computed for the purpose of deciding the threshold of the 44AB limit. And those transactions are in the nature of shares, securities, and derivatives. Again, this is the more litigated issue. Many taxpayers face the problems while uploading the return, and the return is treated as defective by the CPC, and adjustment is done, holding that in your case the tax audit is required and you have not got the accounts audited, and therefore your return is defective or you are exposed to the penalty. In light of this, let us look at some of the guidance note and certain decisions what they have held. What is the kind of how they identify the speculative transactions? The transactions which are settled without delivery and the differences are squared off, those are called as the speculative transaction. As per the ICAI guidelines note, differences whether positive or negative to be aggregated and then compare with the threshold prescribed under section 44AB. Here, even though the transactions are settled on differences, the contract notes are issued at a full value. That is the problem. And therefore, the department takes a view that we will take the turnover as stated in the contract notes. While ICAI guidance note and decision said that the delivery is not taken, so even though in the contract notes, the gross value of purchase and sales are mentioned, however, only differences is to be accounted for, and that should, on that basis, the total should be taken up to compare the threshold prescribed under section 44AB. As against the speculative transactions, there are certain transactions which are delivery based. I mean, where the deliveries are taken in case of stock, shares, and derivatives. If the commodity is held as a stock in trade, then as against the investment, then the sales value is to be taken as a sales or turnover for the purpose of the tax audit. Then derivatives, future, and options. For this purpose, the following be considered for the turnover: total favorable and unfavorable differences, premium received on sale of options, difference in respect of reverse trade, etc. These are to be considered for the purpose of computing the turnover in respect of derivatives, future, and options. In this context, I would like to draw your attention to the Mumbai Tribunal decision in case of Gromor Exports, reported in 78 ITD, page number 95. The question come up in this case that in case of the speculative transaction or something where the delivery has not been taken, how the turnover is to be computed for the purpose of the computing the 44AB limit. I'm just reading what has been held by the court. The tribunal has held that in general the turnover is meant to be the sale proceeds of the goods sold. In other words, commercially, it would mean that the amount of money turned over or drawn in a business in a given time. Since the term turnover is not specifically defined in the Act, nor specifically for the purpose of section 44AB, its meaning should be taken as commercially and commonly understood by layman. If this meaning is applied to the facts of the case, it cannot be said that in the given facts of the case, the assessee has turned over the money to the extent of 7 crores as contended by the department. The balance sheet of the company is only of worth of 34 lakh and almost all the funds are blocked in the fixed assets. Its net current assets are worth only of 52,000 rupees. Thus, it had no liquid funds or working capital which could be turned over to the extent of 7 crores. This is commercial and factual aspect of the matter, and the facts of obtaining in such case, it can be held that there was no turnover at all posted by the company. Tribunal further said, the Sale of Goods Act specifically includes stocks and shares in the meaning of the term goods. Therefore, other provisions of the Sale of Goods Act automatically would apply as per section 6 subsection 3 of the said act, where a contract of the sale, the seller purport to effect a present sale of the future goods. The contract operates as an agreement to sell the goods. In the instant case, the contract through which the assessee sought to buy the units was certainly a contract to buy the future goods. The assessee never took the delivery of the units as observed by the CIT appeal. The contract note clearly specifies the date of delivery as 30 September 1999, that is in future. Even otherwise, there is no evidence to show that the assessee in fact obtained delivery thereof. Thus, the units contracted to be bought were future goods and were uncertain. As per section 18 of the Sale of Goods Act, no property in the goods is transferred to the buyer unless and until the goods are ascertained. Therefore, when the assessee had contracted to buy the units, no property in the said units had passed to the assessee. As a result, it cannot be said that actual purchase as contemplated under the Sale of Goods Act was ever effectuated, and if the assessee never acquired property in the units, it could not pass on the property to the party to whom the units are contracted to be sold by the assessee. In the ultimate result, therefore, there was no sale of the assessee, and where there was no sale, there was no question of receiving the sale proceeds by the assessee, which in commercial sense would be described as either sales or turnover. Thus, in the legal sense, there was no turnover effected by the assessee. The transaction of buying and selling the unit was speculative transaction. No delivery has taken place. The account has been settled by crediting the difference, which is duly reflected in the profit and loss account. No other activity has been carried out by the assessee. In view of the foregoing discussion, the tribunal has held that no turnover was effectuated by the assessee, and hence he was not liable for getting the accounts audited under section 44A. So this was the decision of the Mumbai Tribunal, which clearly supports that despite of the fact that the contract note carries the full value, but in substance, the delivery was never taken, and therefore the settling the differences and then compute the turnover is the correct method. Then next important point is section 44AB provides for the audit of accounts and not audit of books of accounts. A very minor but very critical difference. For this purpose, one can refer to the decision of the Pune ITAT SMC bench in case of S.G. Agarwal. What it says that accounts will be, according to me, the accounts will be wider connotation than books of accounts. In terms of accounts, accounts mean any record or document where the transaction or its particulars are recorded, where the revenue and expenses are recorded, where the assets and liability recorded may form the parts of accounts. It can be said that non-maintenance of books of account is not an excuse to non-applicability of section 44AB so long as some sort of accounts are maintained. So from that perspective, one can refer, if need arises, that what is the difference between accounts and books of accounts. Of course, the difference is very thin and one should not take this in a routine manner. But if at all the occasion arises, there is some guidance available to distinguish between two terms, accounts and books of accounts. Similarly, while certifying the form number 3CD, etc., if the assessee has certain foreign branches, what to do? our institute guidance says that we can rely upon the work of the another auditor, and we can consider the details certified by the branch auditors or other auditor, and accordingly the report can be furnished. The next important clause is whether there is a change in the business, whether incorrect reporting may lead to complications in the, because if the information under this clause is not correctly reported, then there can be complications in the assessment because of the GP calculation or NP calculation and all that. So what is this kind of information and where it is applicable, the auditor has to take care. For example, change from manufacturer to trader. Just a minute. Change from manufacturer to trader is regarded as a change in the business, or whether there is a change in principal line of business, whether the change from wholesale to retail trade and vice versa, or change from full-fledged manufacturing to job work and vice versa, an addition to a particular line of the business. So these are the instances, or discontinuing a particular line of business, reorganization of a line of business, and emerging a new business due to reorganization. These are the instances which can be considered for the purpose of reporting change in the business, because there is a question asked in the form number 3CD whether there is a change in the nature of the business of the assessee. On the contrary, it is also interesting to look into that which situations will not fall in the criteria of change in business. Suppose if there is a temporary suspension of a line of business, then it would not be regarded as a change in business. Similarly, if there is an amalgamation, demerger, and if no new activity is emerging therefrom, and only the scale of operation as business has increased, that does not mean there is a change in the business. Suppose also, for example, a chartered accountant was rendering the services in direct tax, and he has started services rendering services in indirect tax. Then in that scenario also, it cannot be said that there is a change in the nature of the business. So these are the instances which can be applied whether to report this information in a particular clause or not. Amrita?
Yes, sir.
I don't know whether are we only 5 there? I can see only 5 participants. So should we continue?
No, sir. Participants are there. They are sharing their queries as well. It's just that we are not the co-hosts, so we cannot see the participants.
Okay, fine. Yeah.
They are very much there. Yes, sir.
Otherwise, there will be still a penalty to you only to listen me for 2 hours.
No, sir, but I am there, and we are not the co-hosts, so we cannot see them.
Okay. The next point is regarding the method of valuation of the stock, and this is also a critical area in reporting in the form number 3CD. This is the area where maybe because of the pressure of finalizing the audit, and especially if the client is not supported by the skilled staff or experienced staff, and collating the details for other reporting of the clauses in form number 3CD are consuming our healthy time and crucial time of our audit staff in collating the details, and therefore the closing stock area, which is a very crucial area to arrive at the financial position of the client, that sometimes may remain neglected. Therefore, I feel that one should not take it very lightly, and we need to take the due care while certifying the figure of the stock or while accepting the figure of stock placed in the balance sheet in the profit and loss account. The stock valuation complexity revolves around because of the certain method of the valuation of the stock. We are aware that there are broadly 2 methods of valuation of the closing stock, manner. One is, I'm not talking of the FIFO, LIFO or weighted average, but I'm talking about whether the inclusive method of accounting or exclusive method of accounting. And the reference can be found in section 145 capital A, as well as accounting standard 2 prescribed for valuation of inventories by the our institute. So when section 145A says inclusive method means where purchases, sales, inventory are accounted on a gross basis, that means inclusive of indirect taxes, then that method is called as an inclusive method. While when indirect taxes are routed through the balance sheet, that is current liability, and then this payment is squared off against that liability, and indirect taxes are not routed to the profit and loss account, then that method is called the exclusive method of accounting. I think exclusive method of accounting is in sync with the accounting standard 2. However, knowing this, it is very important for us to come to a conclusion whether our client is following inclusive method of accounting or exclusive method of accounting, and accordingly the reconciliation asked under section 145 capital A whether there is impact because of deviation in the method of accounting followed as per section 145A, inclusive or exclusive method, and accordingly the difference has to be reconciled. In this context, there are certain landmark judgments which one has to look into the case of the valuation of inventory. The very famous and a landmark decision is CIT versus British Paints India Limited. It has been held that in this case the valuation was done ignoring the overheads. The practice was followed by the assessee consistently from year to year, that he was not considering the sum of the overheads which are incurred to bring the inventory to the location, and therefore it was in one of the year the AO took the view that the inventory is not valued or it is undervalued. The matter went to the High Court, and it has been held that the method though followed consistently, but it was not a correct method, because to exclude the overhead which are necessary to consider the unit price for the purpose of valuation of the stock, it can't be ignored, and therefore the valuation method followed by the assessee is not correct, and accordingly it was rejected. You are aware that the valuation of the stock is having the spiral impact. Spiral impact means this year's closing stock will become the opening stock of next year. Next year closing stock will become the opening stock of third year, and so on. So there is a spiral impact. So if in 1 year the valuation is changed, then obviously it is going to affect the subsequent year as well. This is the position regarding the stock valuation. Though the Supreme Court in a very landmark judgment in the case of Chandul Sampath, it has been held that valuation of the stock is not a source of income. Nobody can say, though the valuation of stock is important to arrive at a figure of the profit, but per se, valuation of the stock cannot be considered as a source of income. And from that perspective, to argue the cases whenever there is some fault with the valuation of the stock, certainly this decision can come to defend the addition, and therefore I thought that it should be bring to the notice of the gathering. Then the issues are also coming up regarding the valuation of the stock, absolute stock. It should be supported by the evidence. If there is an absolute stock and you are undervaluing it because of the cost price or the market price is low, because it is absolute or slow moving or not moving, then it should be supported by the evidence. Then the authorities do not have any hesitation in accepting the valuation of stock. For that purpose, one can rely upon the decision of Alpha Lawal in the case of 295 ATR 451. I believe it's a Supreme Court decision. Then there is a Rajasthan High Court decision 316 ITR. Then the Delhi High Court decision in case of Reliance Electronics. Normally, this problem arises in the case of electronic goods or semiconductors, etc. And for that purpose, the valuation of the obsolete stock in the balance sheet is an important issue where the tax auditor has to pay the attention, because it is certainly going to affect the taxable income of the assessee. The next point is whether the assessee valued the stock base price quoted on the foreign stock exchange, and the assessee has not considered the domestic market prices. So whether the assessee was justified in ignoring the domestic prices and adopting the foreign stock exchange prices for valuation of the stock. The tribunal or the High Court has held that no, assessee cannot ignore the domestic prices data and directly going to the foreign stock exchange prices just because it is beneficial to the assessee, and therefore that method was rejected by the High Court.
And now the technical team has given us an update that there are more than 2,200 participants, those who have joined in for this live webinar.
Very good. Thank you, madam. Nice to hear that. It will certainly boost my confidence. Thank you. So this was regarding the stock valuation. Then again, the litigation many times arises in the assessment proceedings where the maintenance of the stock record is again a crucial point, and this fact should be clearly reported in the tax audit. Many times it happens that because of the number of items or the volume of the stock, day-to-day stock record is not maintained in the wholesale or retail. Many times we find the stock record in the manufacturing concern or the corporate set of client. As far as the routine clients are concerned, wholesaler, retailers, or traders who deals in a very small item number of items, it's very difficult to find the up-to-date stock record or even the stock record. So many times this question come up in the assessment, and AO makes the addition, and then it leads to the litigation. The courts have held that just because the stock register is not maintained or stock record is not maintained, that cannot be the ground for rejection of the books of accounts. If AO wants to harp upon non-maintenance of the stock record and he wants to reject the books of accounts for not maintaining the stock record, then AO is duty bound to point out certain discrepancy in the books of account, that is in purchase and sales, etc. If he is accepting my purchases, he is accepting my sales, there is no discrepancies pointed out in the debtors balances, creditors balances, or in the indirect tax record, indirect tax assessment, etc. Because if stock record is not maintained and there is some golgafla in this kind of thing, then it will also obviously reflect in my indirect tax assessment. So therefore, just because the stock record is not maintained, this is not the pointed fact that the books of accounts can be rejected, and therefore the AO's point is not correct. That has been held by the Delhi High Court in the case of 325 ITR 95. There could be several decisions on this point. Now the next question is, in case of the builders and promoters, there is always litigation on one point, whether the assessee should follow the percentage completion method or completed contract method for revenue recognition. Because now we are supposed to report on ICDS, etc. From that perspective, this point is also very important while carrying out the tax audit. This is always a litigative area, and quite from the old days, though there is a ICI guidance note on AS9 and AS7, the old controversy whether the promoters and builders, whether they should follow AS9 or AS7. The number of judicial precedents are available holding that the consistent method need to be followed. AS7 is applicable to the contractors, while AS9 is applicable to the promoters and builders. Despite of this, in many assessments, we see that in case of the promoters and builders, the AO or the department took the stand that AS7 guidance, AS7 is applicable. Apart from that, there is a guidance note on revenue recognition in case of promoters builders on a percentage completion method, particularly if the project is very large and project is getting spread over the number of years. In that scenario, the question gets very significance to report the profit and compute the taxable income. I have cited a number of decisions on this. First of all, it is accepted by all the courts that the A7 is not applicable to the promoters and builders. It is applicable to the civil contractors, and promoters, builders definitely are not falling in the criteria of the contractors. Beyond that, it says if at all A7 is applied to the promoters, builders, then it borrows the principle from AS9. That is the thing. And again, there is a formula is given whether including the land cost, 25% cost is incurred, and then if the threshold of 25% is crossed of the total estimated cost, then the percentage method can be applied. Practically, I have came across the cases where because of the COVID-19, the builders which were following the percentage completion method because of the fear or to avoid the branch from the under the fear of the assessment, and there will be unnecessary litigation. But in COVID, the many projects were held up and there was no sale. So percentage completion method absolutely dragged them in the lot of problems, and therefore it can be said that the promoters, builders are not governed by S7, but more the principle of S9 for revenue recognition will apply, and the courts are consistently holding that both the methods are right, percentage completion as well as project completion, and therefore the consistent view has to be taken. If the assessee is declaring the profit based on project completion method, then that should not be suddenly disturbed in one of the assessment years, because that will disturb the whole cycle. Because my assessments are taken up 2 years later on. By that time, I have offered the sale of the next year, offered the profit of the next year, and therefore, if the AO is changing my method in the past years, when my earlier years assessment are picked up, then that will disturb my declared income in the subsequent years, and the whole cycle will get disturbed. In view of this, the courts are taking the view that consistent method has to be given the importance, and both the methods are correct, and even AS9 is also correct for the case of promoters and builders. This is a case of Aditya Builders, Bombay High Court, then Rema Country Holding, Karnataka High Court, and several other decisions. On the principle of consistency, there is a famous decision of Radha Swami Satsang case and Gopal Purohit case of Bombay High Court, where they have held that the consistency has to be seen unless there is some peculiar the method itself is wrong. Otherwise, consistency principle has to be followed. This is regarding the revenue recognition vis-a-vis AS9 and AS7. Important clause for reporting for the purpose of tax audit. At the same time, in the context, I also want to point out the recent amendment in section 43CB of the Act. In light of the discussion and the controversy, and for reporting for the clauses under method of accounting and revenue recognition, one has to consider the amendment brought in by way of insertion of section 43CB by the Finance Act 2018. Finance Act 2018, which is applicable from AY 17 and 18. For the benefit of the participants, I have extracted here and below the text of section 43CB, what it provides for. It says the computation of income from construction and service contracts. The profits and gains arising from the construction contract or a contract for providing services shall be determined on the basis of percentage completion method in accordance with the income computation and disclosure standards notified under section 2 of section 145. Provided that the profits and gains arising from a contract for providing services with a duration of not more than 90 days shall be determined on the basis of the project completion method, or involving indeterminate number of the acts over a specific period of time shall be determined on the straight line method. For the purposes of this percentage completion method, the project completion method or straight line method referred to in subsection 1, the contract revenue shall include the retention money, and contract cost shall not include or shall not be reduced by any incidental income in the nature of interest, dividend, capital gains. So this is the recently introduced section from FY 17-18. However, I feel that after insertion of this section 43 CB also, the cases on promoters and builders which are governed by AS 9 should remain intact and should not be disturbed, because still this is the section 43 CB. It is applicable to the construction contracts or contract for providing services. So I am doubtful whether the construction contracts here is to be taken as a civil contracts again, or construction contract. If you take the view that construction contract here is means the cases of promoters and builders also, then probably my conclusion will be wrong. However, I leave it to for the further thinking of the audience that what will be the impact of section 43 CB. The next important point is very burning controversy, whether contribution received from the employees for various funds which is not paid within the due days as per the respective act, that is ESN Provident Fund Act, whether it can be disallowed if there is a small delay. A lot of litigation was going from number of years. Earlier there was a view that 43B, section 43B covers the employer's contribution, section 36(1)(5)A covers the employee's contribution, and both are in separate. Then in between the view changed and supported by the Jurisdictional High Court of Bombay in case of Gadge Patil, that employee's contribution and employee's contribution are at par, and there is an amendment in section 43B which supports the view that both the cases are to be treated as a part. And it was held that in the case of Allied Motors and alarm extrusion, that the amendment in section 43B is a curative amendment, and therefore that will apply retrospectively, and accordingly the employee's contribution and employee's contribution were brought at par, meaning thereby is employee's contribution is not paid as per the due date of that act, but it is paid before filing the return of income under section 139 subsection 1, then it should be allowed. That was the position that was almost settled in the various courts and tribunals and was being accepted. However, on one fine day, suddenly the decision has come up from the Supreme Court in the case of Checkmate Services. It has held that the Checkmate Services says, no, employee's contribution is not at par with the employee's contribution. Employee's contribution paid within the due date as per section 139(1) is allowable, but employee's contribution has to be discharged as per the due dates prescribed under the ESN Provident Fund Act, and accordingly if there is a delay in payment of employee's contribution, then the allowance cannot be made as per the section 43 capital B, and the entire gamut of the case had changed, entire scene on the platform had changed, and now we are again back to the position that employees and employer contribution are different. So now, though earlier we won the battle, but now the battle is lost, and now there is a disallowance if the employee's contribution is not paid in time. However, again, in two cases, I came across a little bit new point, and that is reported here in below. One is the case of VVDN Technologies, Delhi Tribunal, and another is of the Mumbai Tribunal. It has held that still the assessee has taken up a point that employees' contribution ESI Act says that employees' contribution has to be deposited within the 15 grace period. Question arises, this 15 days grace period is to be counted from the end of which month? The department's point is that this 15 days should be counted from the end of the month in which the salary is due. Assessee's point is that this 15 days grace period is to be counted from the end of the month in which the contribution is paid. That is one. For example, the month of March salary become due in the month of March, but it is paid on the 7th April. So the 15 days is to be considered from April, or it is to be considered from the March. That is the controversy. And I think that no authority has looked into this, and therefore in both the decisions, the matter has been restored for verification of this point and accordingly take a call as per the law. So despite of the checkmate services, I think this new line of controversy has again begun, and therefore one can take precaution while arguing the matter that from this 15 days, what is the exact legal position under the ES and PF Act, which 15 days are to be considered, taking the base of these two decisions which I have considered in my note. Going further, there is one more aspect. We are aware that now there are two sections introduced for the purpose of assessment. One is section 9 capital B and another is section 45(4). 9B section is not falling sorry, under any head of income, salary, house property, profits and gains, capital gain, etc. 9D section is kept outside the heads of account, heads of income, while 45 subsection 4 falls in the under the head capital gain. These both the sections have been inserted by the Finance Act 21. Both the sections are applicable in a scenario where first we'll look at the section 9B. 9B says where any capital asset or stock in trade is transferred to the partner at the time of reconstitution or dissolution, then the section 9B creates a charge on the specified entity when the asset is transferred to the specified person, that is the partner. This is what section 9B. Section 45(4) says the charge will be created at the time of reconstitution when money or capital asset is transferred by the specified entity to the specified person. So right now, we are not concerned with, for our discussion, today's discussion, we are not concerned with the 45(4) because 45(4) is talking about the head capital gain. There is no question of transferring the stock in trade. However, when we come to section 9 capital B, it says when the capital asset or stock in trade is transferred from the specified entity to the specified person, then depending on whether the capital asset is transferred or stock in trade is transferred, the income will be charged either under the head capital gain or under the head profits and gains of business or profession. Now my point is, if suppose 9B is getting attracted for stock in trade to compute the head under the PGBP, and if such amount is considered only for the purpose of computation of income and not credited to the profit and loss account, because it is a computation mechanism, charging mechanism, and therefore there is a possibility that the figure resulting in section 9B may not have find place in profit and loss account, and therefore whether any reporting for such figure is required in form number 3CD. That such and such profit is not credited to the profit and loss account, because we are aware there is one clause which says that any item of income in the nature of income which is not credited to the profit and loss account, other income, capital, subsidy, whatever it may be, there is one, I think clause 16 or something like that. So if that is getting attracted by operation of section 9 capital B, then the tax auditor has to take care whether his report requires a disclosure by virtue of operation of section 9B. This is the point which I want to make, because this figure may not find, I am for the sake of remembering, I am repeating this, that the calculation as per section 9B, when the stock is transferred, may not appear in the books of accounts and directly considered in the computation, and whether this reporting is required in the form number 3CD is the matter to be considered by the tax auditor. Next very highly litigated issue is disallowance under section 14A or reporting for the purpose of 14A. We are fully aware that implication of disallowance on 14A when there is a exempt income. Section 14A has been introduced with a retrospective effect from 1461, and the rule 8D has been prescribed from, I think, 24th March 2008. And now we have to compute the disallowance under 14A, read with rule 8D. We all aware about the development of 14A when it was introduced, what was its initial impact. Sometimes the disallowance is working at a very large figure than the amount of exempt income, and there are a lot of complications. And therefore, we are all aware of that controversy. And also we are aware that if at all there is no exempt income, whether any disallowance is to be called for at all, or if there is no exempt income, then disallowance is not getting attracted at all. So we all are aware about that controversy. However, for the purpose of discussion, I have picked up the peculiar case. What has happened in one case, that there was a share of loss from the partnership firm. So there was no disallowance, because had there been share of profit, then obviously the 14A disallowance may come into the picture. But since there is share of loss, and if the loss is from the exempt source, then I don't take the benefit of that. So therefore there was a share of loss. The question arose whether section 14A disallowance is attracted in this case. Assessee has not made it in disallowance. Assessee said that he has incurred the loss. It is a share of loss, and therefore 14A disallowance is not getting attracted. The AO said nothing doing, even if there is a share of loss, 14A disallowance gets attracted because 14A talks about the exempt income. When matter traveled to the CIT appeal, CIT appeal, relying on the decision of Harprasad case of 99 ITR, held that the share of loss means what? Share of loss means, he said, minus income, minus share of profit. So profit means positive income, and loss means minus income or negative income. And therefore, he said the share of loss is also income, though it's a minus income, but it is income for the purpose of section 14A, and therefore, relying on this decision, he has invoked the provision of section 14 capital A. For the purpose of understanding, and very interesting topic as such, I am reproducing the extract from the Harprasad decision of 99 ITR. It says that from the charging provisions of the Act, it is discernible that the words income or the profits and gains should be understood as including losses, so that in one sense profits and gains represent plus income, whereas the losses represent the minus income. Some Karamchand upper case was also referred 40 ITR, another decision from 40 ITR. In other words, loss is a negative profit. Both positive and negative profits are of revenue character. Both must enter into computation whenever it becomes material in the same mode of taxable income of the assessee. So taking the premise, taking the stand based on this decision, the CIT appeal confirmed the action of the AO, saying that in case of the share of loss from a partnership firm, the 14A disallowance gets attracted. The matter traveled to the Pune bench of the tribunal, and in the case of Kumar Properties reported in 190 ITD, the Pune tribunal has taken a view that the CIT bill observations are incorrect, not acceptable. And the tribunal has held that minus share of loss or minus share of profit is equivalent to nil income. It is not minus, it is equivalent to the nil income for the purpose of section 14 capital A, and therefore if there is a nil income, then no disallowances are called for. That is the legal position, and accordingly the tribunal has deleted the entire disallowance. For the sake of understanding, I am repeating the head note from the decision which is reported in 190 ITD for the assessment year 13 and 14. It says income expenditure incurred in relation to income not includable in total income. AO observed that during the course of assessment proceedings, that assessee company was a partner in M and had invested income from which was exempt. AO made disallowance of 0.5% of average value of investment. CITF will confirm the disallowance. The Judicial High Court has, in case of HSBC 421 ITR, has held that disallowance cannot exceed the exempt income so earned by the assessee during the year under consideration. If disallowance is to be restricted to the amount of exempt income, sequelated is that there can never be any disallowance under Section 14A in absence of positive income for the year. Insofar as Section 14A is concerned, there is no qualitative difference between the two situations. First, where the income exempt is nil, and second, where there is a negative income for the year, joined with the possibility of earning the positive income in future. As assessed in the instant case, admittedly did not earn any exempt income during the year, respectively following the ratio of the above decisions. No disallowance was called for, impugn order is overturned, and assessed ground is allowed. So this is the position which has been finally upheld by the tribunal, that Harprasad case is on a different set of fact, different footing, and here the minus share of profit means nil income, and if there is a nil income, then 14A not gets attracted. That is the ruling. I think it's a very important development, and therefore very frequently the members may come up where there is a share of loss, and the question being litigated whether in such scenario 14A disallowance is called for or not. From that perspective, I feel the decision is very important. The next part is reporting of subsidy, whether it's a capital receipt or revenue receipt. In the many decisions, we have come across this issue, whether subsidy is a capital receipt or revenue receipt. I will take you through the various decisions which are very interesting. And subsidy can be in the form of off-try refund or interest subsidy or electricity refund, etc. And grant or reimbursement of certain expenses. It can take any form. And therefore, many times the question comes up whether the subsidy is a revenue receipt or a capital receipt. And that is one of the important points while reporting under section in form number 3CD. By and large, the courts have gone, including Supreme Court, they have gone on the premise that what is the object of the subsidy? What is the scheme of the subsidy? Whether that scheme, what it says, whether it is for supporting the setup of the industry or what, then according to the object of the subsidy scheme, the courts are taking the view whether it's a capital receipt or subsidy revenue receipt. The very famous decisions are PJ Chemicals 210 ITR, very old decision, Koni Sugar Chemicals, Reliance Industries, Sahni Steel, Meghalaya Steel, all are mostly of the Supreme Court, and few of them are from our Judicial High Court also, which have laid down that whether the subsidy is a capital receipt or revenue receipt is to be looked considering the what is the object of the scheme and what is the object of giving the subsidy. There is a very latest decision of the Pune Tribunal in the case of Hyundai Construction, which has also held that the subsidy is a capital receipt. However, having noted that there are so many precedents available from the Supreme Court, some of the important developments in this regard are very important. First of all, I want to bring to the notice the amendment in section 224, subclause 18. It says that assistance in the form of subsidy or grant or cash incentive or duty drawback or waiver, concession or reimbursement by whatever name called by the central government or state government or any authority or body or agency in cash or in kind to the assessee other than a subsidy or the grant or reimbursement which is taken into account for determination of actual cost of the asset in accordance with the provisions of explanation 10 to section 43(1), which talks about the determination of the cost of the asset, or the subsidy or a grant by the central government for the purpose of corpus of the trust or institution established by the central government or a state government, as the case may be. So this is the amendment brought in section 224 clause 18. This amendment was not there when there was a decision from the Supreme Court in case of PJ Chemicals or San Steel, etc. This is the latest development, I think, from 2015. So now grant or subsidy with the certain exceptions have been included in the definition of section 224 itself, where it is stated as an income. However, it calls out the position where the explanation, as per explanation 10 of section 43, the cost is made for meeting the cost of a particular asset, then that cost of acquisition of the asset is to be reduced by the amount of subsidy or grant or reimbursement, and accordingly the cost of acquisition of the asset will be reduced. It will affect my depreciation, and accordingly the depreciation will be granted. This is the combined reading of section 2 subsection 24 clause 18 as well as explanation 10 to section 43. So one has to test the facts of the case in light of the earlier decisions which I have cited, as well as whether you are hit by amendment of section 224(18) or you are hit by explanation 10 to section 43, and accordingly the call has to be taken whether to report subsidy as a capital receipt or a revenue receipt. One more important point which I want to highlight is that sometimes the subsidy or the grant is received from the foreign government. Question arises whether subsidy or a grant received from the foreign government is falling in section 224 clause 18. Is it falling under explanation 10 to section 43, or since it is not received from the Indian government or Indian authority or a person prescribed as a person under the Income Tax Act as per section 2 section 31, whether foreign government subsidy remain untouched and it is not to be treated as revenue because none of the amendments covered the foreign subsidy. And the issue had come up in the case of Delhi Tribunal, in the case of Spectrum Coal and Power, and Madras High Court in case of Tube Investments, etc. And these are the two decisions. For the sake of understanding the controversy, I would go back to the earlier portion and read it for the purpose of explanation 10. I'm reading explanation 10 to section 43. It says, where a portion of the cost of an asset acquired by the assessee has been made directly or indirectly by the central government or state government or any authority established under any law or by any other person. So central government, state government and authority established under law, it is very clear that it is referring to the Indian scenario. However, whether the terminology used by any other person will be sufficient to cover foreign government. That is the issue. Here the tribunal and the courts have held that person includes individual, partnership firm, Hindu undivided family, AOP, body of individuals, company, artificial juridical person. These are the other person criteria prescribed under section 231. Therefore, the foreign government or the foreign authority giving the subsidy does not fall that it is coming from central government, it is coming from state government, or it is coming from other person. And therefore, if you have received the subsidy from the foreign government, it is good case to take the view that the subsidy is a capital receipt and not hit either by section 224 clause 18 or explanation 10 to section 43. This is what the case says, and for that support, the support can be had from the case of Spectrum Coal, which is direct decision on this. In case of Tube Investment, that issue is not directly there, but however, there was also a subsidy received from the Dutch government from Netherlands, and that was held as a capital receipt. That takes me to the next issue. Many times I observe that there is an incorrect reporting under clause 48(2)(b). 48(2)(b) talks about the payment to the specified person or a relative. What is specified person? Which relatives are covered? In case of partnership, partner is a specified person, or relative of a proprietor, relative of a partner, relative of a member of a company, or member of a AOP, POI. These are the specified persons where you have to compare whether the payment made to the specified persons is contained in the provisions of section 40(a)(2)(b). That means the payment made to the specified person is in excess than the reasonableness criteria or benchmarking applied for the purpose of determining the reasonableness of the expenditure under 48(2)(b). Many times I observe that when the remuneration and salary or interest is paid to the partner, according to me, it is a fit case to report under section 48(2)(b), because partner become the specified person within the meaning of section 48(2)(b) for the purpose of firm, and therefore that has to be reported. But many times the many professional brothers are probably escaping this fact, and remuneration interest to the partners is not found place in the respective clause, which according to me is an incorrect position. Then certain interesting issues are arising around this area about calculation of interest and remuneration to the partners. First of all, 40(b), 40 small b small plus 4 and 5, it says that interest and remuneration is to be authorized by the partnership deed. That is the language it has been used. Question arises, what is the instrument of partnership deed? Can there be only one document falling under the nomenclature of instrument of partnership deed, or at one time there can be multiple documents in the form of letters, memorandum of understanding, etc., which can be regarded as instrument of partnership deed? I found one reference in the case of Amritsar Tribunal, where it has been held that instrument of partnership does not mean that only one deed. For the purpose of understanding, I am highlighting this portion on the screen, that instrument of partnership does not mean only one partnership deed. It may constitute any other formal transfer. If the terms of the partnership are contained in a number of documents or in correspondence between the parties or letters exchanged, those can also be as partnership, instrument of partnership. I think this decision is very important, and this needs to be considered if it is helpful for the purpose of litigation, that this stand can be taken whether instrument of partnership means only a formal partnership deed or it can take any other form. Though some more research on this point is required, but I think initially it is very important point to keep in the mind. Next, whether who is working partner is actually a factual issue. Working partner means the working partner who is actually devoting the time for the purpose of the partnership one. It's a question of fact, not a question of law. So it has to be decided by considering the facts of the case, whether the particular person, whether it's a male or female, who is the capacity of the partner, is actually devoting the time for the purpose of carrying the business of the partnership firm and can be regarded as a working partner. Because if it is turned out that the particular person is not a working partner, then the remuneration can be disallowed. And for that purpose, the decision of Kerala High Court of 184/1 is very important. The next is, the language says that interest and remuneration to the partner is to be authorized by the partnership deed. It never says that interest and remuneration is to be quantified. It only says it is to be authorized, because some AOs are taking the view that your partnership deed is not quantifying the remuneration interest to the partners, and therefore it is a violation of the law, and therefore they are disallowing the remuneration, saying that it is not quantified. In that context, the court has held that the provision says that remuneration interest has to be authorized by the partnership deed, not is to be quantified by the partnership deed. From that perspective, the Cuttack bench of the tribunal, the observations are quoted like this: that as per the provisions of Income Tax Act, the partnership deed should provide for payment of remuneration to working partners. It does not provide that the remuneration paid to the working partners should be fixed by the partnership deed, or that partnership deed should provide for the method of remuneration to the working partners. And I think this decision is very important, looking at the controversy of the issues. Then the question also comes up, payment to the partners not provided in the partnership deed, and some payment is made apart from remuneration and interest to the partners, but it is justified on the basis of commercial expediency. Can it be claimed, or can it be disallowed under section 40B, just because the payment is authorized only in the form of remuneration of partner? The issue had come up before the Amritsar bench, where it was held that partner of the firm purchases the goods from the firm. Firm was allowing 10% discount to the other customers if there is a good amount of the quantity of purchases. Here the partner also purchases the goods from the firm, and the purchases were voluminous. So on the same criteria, the discount as given to the third party was also given to the partner. The question arose in the assessment that this discount allowed to the partner is not allowable as per section 40B, because it is not authorized by the partnership deed. The court have taken a view that no, discount is not remuneration. It is justified looking at the commercial expediency, as discount is allowed to the third parties. The same way, the partner is also entitled, if he is making the purchases in his individual capacity from the firm, and he is entitled for the discount, and therefore the discount was held to be allowable. So this issue may come up. Then the next issue is how to compute the book profit for the purpose of calculation of remuneration to the working partners. For that purpose, the attention is drawn to the explanation 3, which provide explanation 3 to section 40B, which talks about how to compute the book profit. It says that book profit means the net profit as shown in the profit and loss account for the relevant previous year, computed in the manner laid down in chapter 4D, as increased by aggregate amount of the remuneration paid or payable to all the partners of the firm, if such amount has been deducted while computing the net profit. In light of this, we say that book profit means profit and loss account as per the profit and loss, but which is computed in the manner laid down in chapter 4D. What chapter 4D provides for? Chapter 4D provides for computation under the head profits and gains of business or profession. It talks about starting from section 28, which defines what is included in the profits of the business, and then it says section 29, which talks about the various allowances and disallowances from section 30 to 43D. So it says, as per this method, as manner laid down in chapter 4D, the amount of the book profit has to be calculated. Many times the question arises that certain items of the income, which are not per se business income, but are credited to the profit and loss account, whether those income are eligible for computing the remuneration to the partners, or that kind of stream of income has to be reduced from the profit disclosed from the profit and loss account while computing the remuneration to the partners. That is the issue. Most commonly, which will find that interest on FD, which is taxable under the head income from other sources, or interest on income tax refund, which is calculated as income, which is computed under the head or chargeable under the head income from other sources. These are the items of the income. Or suppose there is a donation debited to the profit and loss account, whether these items need to be considered for the purpose of allowance and disallowance while computing the book profit for the purpose of computing the remuneration to the partner. That is the issue. My view is it is better to exclude these receipts or stream of income while computing the profits and gains of business or profession to avoid the unnecessary litigation if these amounts are not very material. However, if the amounts are material, at least for income side, you have the contrary view, which supports that even though item is taxable under the head income from other sources, but if are credited to the profit and loss account of the business, then it can be considered for the purpose of computation of salary for the partners. For that purpose, the decision in the case of Sirajuddin and Brothers, Calcutta High Court 210 taxman is very important. It says that the said chapter nowhere provides. Said chapter means chapter 4D. Chapter 4D nowhere provides that method of accounting for the purpose of ascertaining net profit should be the only income from business alone and not from the other sources. Section 29 provides how the income from profits and gains of business or profession should be computed, and this has to be done as provided under section 30 to 43D. By virtue of section 5 of the said act, the total income of any previous year includes all the incomes from whatever source derived. Thus, for the purpose of section 40B5, read with explanation there cannot be separate method of accounting for ascertaining the net profit or book profit of the business. The said section nowhere provides, as rightly pointed out by Mr. Ketan, that is counsel for the SSC, that the net profit as shown in the profit and loss account, not the profit computed under the head profits and gains of business or profession. So maybe it may not be a profits computed under the head profits and gains of business, but it should require only a manner of computation, and it talks about only the item of income. So because for expenses there is no question of computed under the income from other sources. The computation under income from other sources will arise only for the purpose of particular stream of income, that is interest on FD or interest on income tax refund. So at least these items are safeguarded by the decision of this Calcutta High Court. However, if there is a donation, etc., debited to profit and loss account, I think this decision will not support, and donation, etc., has to be added back for the purpose of computing the salary and remuneration to the partner. For the purpose of benefit and discussion, I have restricted the wording of section 29. It says that income referred to in section 28 shall be computed in accordance with the provisions contained in section 32, section 43D, and accordingly the allowance and disallowance is to be computed. Taking ahead some of the points on remuneration and interest to the partners, the issue is also coming up whether the interest on capital is to be computed on the opening balance or closing balance or day-to-day balance of the capital account. The issue had come up before the Hyderabad bench, and it has been held that it's better to compute the interest on capital on the closing balance, because in the business the profit cannot be said to accrue on day-to-day basis. Profit accrues only at the end of the year, which is credited to the capital account, and maybe withdrawals may be against the profit or not against the profit. However, it is better to compute the interest on capital on the closing balance rather than computing the interest on the opening balance. and for that purpose, the decision of 92 ITD can be relied upon. One more important issue, whether interest on capital can be considered after considering the revaluation credited to the capital account. Now there is a burning section 9B and 45(4), which I already referred. Because of that, and the decision of the Mansukh Bhai's case, now the revaluation strategy may not be very common as it was in the earlier days. However, if at all there is a revaluation of asset and revaluation is credited to the partner's capital account, and because of that, if the partner's capital account is going to increase, the question arises whether interest on capital is to be computed after considering the revaluation profit credited to capital account, or it should be computed before taking the balance into account before revaluation of such asset. So the courts have held that if the revaluation amount is credited to the partner's capital, then that capital balance can be considered for the purpose of the computation of interest on capital, and that there is no flaw in the considering the said capital balance, and interest on the capital accordingly can be computed and can be allowed under section 40B 5 or 4, what it is. I think, friends, it's already 7:45. Amruta,
Yes,
so I think I have come to an end of my presentation.
Yes, sir.
You are the best judge to give the feedback to whether I met the expectations of the delegates or not. I tried my best, and once again, thank you to the Institute, Tax Quality Review Board or Tax Audit Quality Review Board and Pune branch, Shekhar Chidle sir, Chawla sahab, and all that for giving me the opportunity to sharing my knowledge. I'm handing over the mic to you for question answer, if at all I need to clarify something.
Yes, sir. We have got few questions. With your permission, can I read them out for you?
Yes, sure.
What is the audit procedure to be followed to verify if TDS is not deducted on specific amount of expenses? I mean, where the client has voluminous transactions.
For voluminous transaction, there cannot be, there is no any procedure prescribed by way of rules or institute guidance, etc. I think it's a professional risk. You can only apply the test check basis. At least you can look at the amounts which are material. And if you look at a particular account of the service provider or the recipient, you will find in the, suppose even if you examine the account for 6 months, etc., you will come to the pattern that assessee is aware where to deduct the tax and where not to deduct them. If you are finding that the percentage of errors is quite high or the omissions are quite high, then I think you have to extend, or you have to at least give a disclaimer that there are certain instances where tax has not been deducted, or otherwise there are instances on take basis where you are not find any failure as such. So it's I think the professional call, but it's not from the TDS returns or that, or even on an aggregate basis. Suppose if you take the total of the credit side of the supplier, and suppose the rate of tax applicable is 2%. I think on an average, if you apply the 2% of the credit side, you will come to know the figure of TDS required and what is the ultimate TDS deducted. So, and nowadays, there are software where the tally software can be converted into Excel, and you can get the columnar position of the ledger extract. And I think it's not difficult. On an aggregate basis, one can easily compare the total credit lying in the supplier or vendor's account and whether rate of 1%, 2%, 10%, 5% is applicable. And I think accordingly, if there is a huge gap, that 2% figure comes to 2 lakh, and if the TDS is coming on 1 lakh, then obviously there is a cases that there is a omission and provision is not complied with.
Thank you, sir. Yet another question, specifically with respect to the primary agricultural cooperative credit societies. The member wishes to know that they are accepting the various types of deposits like saving, recurring, and term deposits from its members. So is section 269 SS applicable to them? Subsequently, they also want to know that they also provide KCC loans to their members, and the members repay their loan in cash exceeding rupees 20,000. So again, is section 269 SS applicable to them in case of acceptance of cash from members in the nature of repayment of loan given to the members?
Right. Let me look at the section. I'm just reading from the section 216 SS. Mode of taking or accepting certain loans, deposits, and specified sum. No person shall take or accept from any other person, hereafter referred to as the depositor, any loan or deposit or any specified sum, otherwise than by an account paid check or account paid bank draft or use of electronic clearing system bank draft, bank account, or through such other electronic mode as may prescribe, if the amount of loan deposit is aggregate exceeding on the date of taking such loan or deposit or specified loan or deposit taken accepted exceeds certain amount, then the amount or the aggregate amount referred in clause A and together, then we talk about the 20,000 rupee limit, provided that the provisions of this section shall not apply to any loan or deposit or specified sum taken or accepted from, or any loan or deposit or specified sum taken or accepted by government, any banking company, post office, saving bank or cooperative bank, any corporation established central, state or provincial act, government company, or any other institution, association, body or class of institution, association or body to the central government may for reasons to be recorded in writing specify in this behalf, provided further that provision section shall not apply to any loan or deposit where the person from whom the loan or deposit or specified is taken or accepted and the person to whom the loan or deposit or specified sum is taken or accepted are both having agriculture income and neither of them has any income chargeable under the Act. Then 15A, which has been inserted with Section 1423, provided also that a provision of this section shall have effect as if for the word 20,000 rupees, the word 2 lakh rupees had been substituted in case of the any deposit or loan where such deposited is accepted by a primary agricultural credit society or primary cooperative agriculture and rural development bank from its members, and such a loan is taken from a primary agricultural credit society or primary cooperative agricultural land and rural development bank as its members. So I think if you can, I can recall the question. It is talking about agricultural cooperative society, right?
Yes, sir. PSES.
Yeah. So now there is amendment in the Act with effect from 1423, where the provision is applicable, but the only limit of 20,000 has been increased in such case from 20,000 to 2 lakh. This is my reading of the section.
Thank you, sir.
I'm not aware about the legal position as such, but from the plain reading of the section, and particularly in the amendment brought in by Finance Act 2023, I think the point is clear. If it is a case of primary agricultural credit society, it is talking about that.
Yes, specifically they've said that it's a PSES.
Yes, yes.
The next question is that the cooperative societies are selling fertilizers, pesticides, and the seeds to their members. And on the other hand, they are also providing loans to their members. So they have received interest on their deposits. Suppose the sales are 40 lakhs and the interest on loans received is also 40 lakhs. And interest on deposit received 40 lakhs during the financial year 22-23. So is the society liable for tax audit for AY 23-24?
So there are three sale 40 lakhs, right?
Yeah.
And 40 lakhs is interest.
Yes.
And one more?
Interest on deposit and interest on loan.
So that will also constitute business, because as from the question, it appears to me.
It is with respect to the cooperative society.
Yeah, I agree. But one is a clear-cut sale of fertilizer.
Yeah.
While the question is asked in this version that the society is also engaged in giving loans and accepting deposits. I don't know whether when they are indulging in the activity of fertilizer, whether this is
permissible,
permitted.
But
even suppose it is not permitted, it's illegal business. But if it is constituting as a income from business of the society, because there is no bar to earn the illegal income. So even if the activity is not permitted by the rest of cooperative societies or by the memorandum on article, but if the society is said to be carrying on the business of giving loans and deposits, and that interest income will also constitute as income of business, then I think 40 plus 40 plus 40, that is exceeding 1 crore. So according to me, the tax audit is applicable.
The next question is with respect to the medical practitioner professional. The member wants to know that his client, who is a medical practicing professional, has professional receipts of 38 lakhs. As per section 48 ADA, he has to disclose 50% profits, and the profits are less than that. Books needs to be audited. So he wants to know that if the profits is less than 50%, do TDS provisions apply? And according to this, if the receipt is less than 50 lakhs, do he need to deduct TDS?
I think according to me, yes, because it says the TDS provisions are applicable if 44 AB is applicable. And as per this, if the property is not disclosed, then 44 AB will come to the picture. 44, I think 44 AD subsection 4. And by any means, if the 44 AB is stepping into the shoes or getting invoked, then I think because the TDS provision only says the person to whom the tax audit is applicable, or audit on 44 AB is applicable, then he has to comply with the TDS provision. So according to me, it should be applicable.
Okay. In case of a proprietorship and a partnership firm, the turnover is more than 2 crores, but less than 10 CR. So in this case, cash portion is less than 5%. So is tax audit applicable even if profit is less than 6% or 8%?
Here, this issue is very, in this particular season, this issue is flashed by many professionals. See, first of all, when you are complying with the 95% condition, that means cash is less than 5%. So your turnover limit is getting increased from 1 crore to 10 crores. Right? Now, in your case, in the query's case, what is the turnover limit?
2 crores.
Sorry, what is the turnover? 2 crores.
Yeah, but less than 10 CR.
Yeah, it is more than 1 crore. So as per normal provisions, he is to get accounts audited. However, he is complying with the 95% threshold of cash receipts. So the turnover is substituted by 10 crores.
Okay.
So in this case, even if he does not offer the profit as per presumptive taxation, he should not get the accounts audited, because the turnover itself is limit is 10 crores, which is applicable, and he is not violating that. Had it been a case that the turnover limit is crossed and the profit is not declared as per the presumptive taxation, then, but here, even if he is not declaring the profit as per presumptive taxation, as per normal provision of the act itself, his turnover less than 10 crores. So according to me, he is not liable to get the accounts.
Okay, sir.
Just
can we take last 2 questions?
Just a minute.
Yes, sir.
I think I have marked this situation. I'll just read. It is in the taxman's book I'm reading. It is page number 12. The eligible SSC are entitled to higher turnover, total sales, gross receipts, threshold of 5 crores, 10 crores with effect from assessment at 21-22. For non-audit, show lower than 6% or 8% of their gross receipts or turnover or profit from business if they satisfy the 95% cashless condition. So they are entitled to higher turnover 10 crores. This is exactly what I'm saying. Yes.
In case whether the remuneration credited by the book entry to capital account of partner entitled to deduction subject to the compliance of rest provisions if amount is not actually paid.
Yeah, there is no condition that it has to be paid.
So it is eligible.
Yeah, it is not an item falling in 43B, which are allowed on actual payment basis.
The last question, if, with your permission, sir.
Yeah.
If any increase in profit is shown under ICDS, it is, it is due to the disclosure requirement and does not have any impact on taxable income of the assessee company. The tax auditor has also mentioned in tax audit report that there is no impact on company profit. But in this case, CPC has made addition for increase reported in TAR, although no addition is indicated in tax audit report due to no impact on profit. So what is to be done in this situation, sir?
Only appeal can be filed.
Okay. Okay, sir.
And the intimation appeal has to be filed. Because it's a question of merit, and appellate authority will look into whether really it is impacting the competition or not. Merely filing 154 application or revising the return or filing the rectification application may not support. And if particularly the amount is material significant, then appeal is the only advisable course.
So I have covered all the questions by the participants in the chat box. Subsequently, I would also like to make a mention to all the participants that sir has very recently co-authored ICI publication on technical guide to virtual IT-80 proceedings. So sir, we seek your good time and convenience for the upcoming session on this topic as well. And thank you so much for the wonderful interactive session, as well as the latest case studies and the practical nitty-gritties involved in this busy tax audit season that will be useful for everyone. So thank you so much for your valuable time and guidance. I have quickly 3 announcements suggested by the admin team. So with your permission, can I make them? And then I propose a formal vote of thanks.
Sure.
So the TAQRB has requested all its participants to share their queries, if any, with respect to this webinar. So, and that can be shared on the email taqrb@icai.in. This typical specific series number is 9. Today's session series is 9. So please make a note of the same. The participants can access the PPT of this webinar. Sir has not made a PPT as such, but the study material, which he will be sharing with the participants and the organizers of this webinar, and all the previous webinars of this series of tax audit seminar under knowledge sharing tab of our official website, taqrb.ici.org. The participants can also watch the recording of this webinar and all previous webinars by selecting Taxation Audit Quality Review Board in search bar on official website of our institute. So on this note, I really take this opportunity to propose a formal vote of thanks, or rather we should say we shall remain grateful to you, sir, for your valuable time and guidance on today's session, Web Series 9. I also place on record formal thanks to CA Dr. Raj Chawla, sir, Chairperson of TAQRB, CA Sivi Chittade, sir, Vice Chairperson of the TAQRB, and also providing us an opportunity to moderate and navigate this session. Last but not the least, the audience for the wonderful responses and the questions. That was a very nice response we've received today. The coordinators and the technical team, we also thank you for your continued support. Thank you so much. And Agival sir, I request you to share this case studies and the short note study material so that we can upload it at the website for the benefit of the participants.
So Amrita, just let me know where is it to be mailed to you or what to do.
You can share it. You can share it with Dharmendra ji or me, either ways, or on the TAQRB official emails. They will get in touch with you.
So I will send this today only.
Thank you so much, Rajendra Agiwal sir. Thank you so much once again to all the participants, organizers, and the technical team. Thanks a lot. Good night.